Good morning, everyone. Welcome to our property construction update. I hope everyone is well. I'm joining you from the sunny Newark-on-Trent this morning. I think we've got some more people will be joining us as we move through, but it's 10 o'clock, so we'll get started. Just some housekeeping before we start. I'll be joined later by Matthew Appleyard, our head of corporate tax, who will be talking to us about all things tax and property related. We also will make sure we're finished by 11 o'clock. And as we move through, if you have any questions, then please use the Q&A box at the top of the screen, and we'll look at those as we go through and make sure that we address them towards the end of our presentations. So I'm going to start off the presentation with a general overview of property and construction, and as I see the market and the challenges at the moment. The last time I gave a similar presentation, I was told that I was a little bit downbeat on things, so I'll do my best to be a little bit more upbeat today and see whether we can look at what's happening in the market. So we've got to recognise, to start off with, that there are some challenges, and I appreciate there are different people on this call with different interests, whether they be construction people, whether they be people investing in property. So we'll try and cover all bases. But just dealing with the challenges to start off with, we're in a period of inflation, we all know that, and that inevitably has an increase in costs both for businesses and for individuals. We've gone through a global pandemic. Thankfully, that's hopefully behind us, but obviously that did have at the time a massive impact on all businesses, not least construction and investment in properties. We continue to see material supply issues for all sorts of reasons, whether it be demand, whether it be international events, but material supply issues have affected an awful lot of construction businesses. Labour, both in terms of the right labour at the right price and at the right time. So we'll take a look at that. Interest rates, we've just seen the 13th consecutive interest rate increase, and that inevitably will have an impact on both individuals and businesses. And house prices, there still remains a lot of uncertainty about house prices, and we'll take a look at what that might mean to businesses, to consumers, and to the construction industry. So trying to be a little bit more positive to start off with, and let's have a look what's happening at the moment. A recent report has shown that 25% of construction firms are expecting increased turnover in the next 12 months. Whether the other 75% are expecting it to be flat or decreasing, it didn't say, but 25% is a good number of firms which are expecting their income to increase. Most firms are reporting they're back to pre-coronavirus levels, which is excellent news. There's a very, very small increase in construction activity in March, but by 0.2%, which you could almost say is flat. But behind that, we have seen a fall in private housing activities, the construction of that down by 1.4%, and an increase in infrastructure work. So that's the larger projects that we're seeing, mainly government and local authority funded. So let's have a look at inflation. So we know that general inflation to March 2023 was just below 9%. And we're all expecting that to fall in the coming year for lots of reasons, such as energy prices and supply of materials. Looking specifically at construction and building materials, we have an 11% increase during 2022 and a 9% increase in March 2023. And that's probably a bit misleading, because I'm sure in your own businesses, you can give me examples where materials have increased by far more than that. If we look at things like gravel and sand, if we look at things like insulation materials, they outstrip those increases many, many times. And what really matters in your business is what that increase means to you. Are you passing those increases on to your customers, or are you absorbing those increases in your own profit? What I'm finding is it's probably a mix of both. So I'm finding that some businesses are able to pass those increases on, Other businesses are having to absorb that into their profit and reducing the margins they're making. Similarly with labour costs, although labour costs haven't increased at the same rate as general inflation, and in 2021 we saw no increase, you probably all know the reason for that. 2022 we saw a small increase, and we're expecting a small increase in 2023. But again, thinking about your own business, can you get the right people at the right time with the right skills? And if you can, what's the cost of those people to you? And you're probably going to tell me that 4% increase is well below what you're having to pay for the right people at the right time. In the wider market, we're looking at about 7% increase in the private sector. So although construction is slightly behind that, like I say, in practical terms, I think most of us are going to find that finding the right people at the right time is going to cost us more going forward. We've also had the national minimum wage increase. Now, I appreciate that lots of businesses, and probably many on this call, won't have people being paid the national minimum wage. But what that does do is put pressure on the people above them who look down and go, well, they've had a 10% pay increase, whereas my 10% pay increase. So I think all this feeds into the ever increasing cost of labour, especially the right labour at the right time. Moving on to residential properties, just put some figures up there for the average Lincolnshire house. Again, Lincolnshire is a very big county, so we'll all see differences there comparing, say, Boston with Stamford. We'll probably see with Newark, we'll probably see massive increase in those. But what we have seen is a steady increase, and we've just got some figures there for the averages across the area. Similar to Nottinghamshire, again, the figures are slightly different, but the increase is the same. So that's really showing us that despite all the pressures and what the Bank of England is doing with interest rates, house prices have continued to rise. Looking forward to 2023, we've still got high demand for new build properties, and the government set a target of £300,000 new homes per year. My question would be, who is going to build them, and is the demand for them? If I think about where I live locally, there's a large housing estate being developed. They put up probably the first 30 homes and almost shut the site down. That could be for lots of reasons, but I'm thinking, is that because they don't feel they can get the right price at the moment with the uncertainty in the market, and they're actually going to hold on to those properties until they feel that the prices are at a level which gives them the profit they need? Forecast for the current year, most people are saying an 8% reduction. I've seen scare stories of 35% reduction, tend to discount those. I mean, that would be a completely horrible position to find ourselves in. I think 8%, somewhere between 8 and 10% in the coming year might be a reasonable adjustment, especially with interest rates and the cost of living increasing and people's spending power continue to be restricted. Whilst we're on residential properties, something that's just happened this week is that I've seen the first 100% mortgage. Now, this is very restricted on who it's available for. It's only available to first-time buyers. It's only available to those that are moving out of rented accommodation, and they must have an unblemished record of paying rent and utility bills for the last 12 months. My thoughts on this are that, yes, 100% mortgages may free up some demand. It may enable certain people, the right person, to move out of rented accommodation into their first home. But again, will those mortgage companies be looking for a downward squeeze on prices so that should the lender default, then there's some equity in the property? I don't think it's going to be very popular. I don't think it's going to be massive uptake, but I think where there is, I think the lender is going to be looking at being very aggressive in terms of downgrading the value of the properties that are being mortgaged. Continue with the rental market. There were lots of people on this call, I imagine, who have got rented accommodation, and the big topic at the moment that I'm hearing is the increase in mortgage costs and what knock-on effect that has onto rental charges. Also, we're finding that buy-to-let mortgages are becoming more difficult to get, more expensive to get, and again, that might squeeze the availability of rental accommodation. Hot off the press this morning, we've had the announcement of the private rent reforms. We haven't got much detail on that yet, but the headlines are end to no fault evictions, good for tenants, perhaps not so good for landlords. Increased rights to tenants, so we're talking about things like requesting to have an animal in the house or a pet in the house. But on the plus side for landlords, they will be easier to repossess for antisocial behaviour of tenants. So where tenants can be proved to be misbehaving and being disruptive, then hopefully the process of removing those tenants will be a lot more straightforward. Like I say, we are very, very early in the knowing what that might be. We haven't got much details yet. And with all these things, I imagine it's probably going to be 24, 25 before we actually start seeing any legislation in place. Everyone's favourite subject, interest rates. This shows that we are moving back towards 5%, which was the figure in April 2008. When I did a similar presentation earlier in the year, I quite confidently said 4%, that's it. We're going to top out at 4%. I think now we're looking more likely to be topping out at 5%. Again, can easily be proven wrong in the coming months. But what really strikes me about this graph is the 1% line. We have there all the way from February 2009 through to June 2022, where interest rates have been less than 1%. And that is a whole generation of homeowners and who just haven't known interest rates at what we might call a normal level. Danger for that is, as those people either look to move or to come off fixed term deals, it's going to be quite a shock to the system, and that might have a constricting effect on the housing market and people's ability to move. The pleasing thing that we're seeing is, although base rates are increasing, we're seeing some quite attractive deals, or attractive in today's market anyway, of mortgages. If we look at a 75% loan to value typical mortgage, we're looking somewhere between 3.99 and 4.25% fixed for anywhere between 2 and 10 years. Yes, years 5 to 10, you might be kicking yourself that you've gone for a fix at 3.99, but I hope that does give some sort of certainty to the market that people can know what they can afford, they know what their outgoing is going to be, and be confident to invest in property and to move into property, and again to free up that market, which, as we know, if we think back to October 2022, was completely turned upside down almost overnight. Moving back to construction and looking particularly at Lincolnshire and public spending, I think in the sectors of construction, I think there's going to be a lot more opportunities for publicly funded, shall we call it, works rather than privately funded works. So if we give you some examples here, we've got new school builds. So we've got 5 schools there in Lincolnshire which have been announced for new builds. Now they are the announcement dates, not the build dates. And I know from personal experience, from announcement to build can be anywhere up to 5 years. But again, assuming that they go forward, that will provide opportunities in the construction industry locally. We're also seeing large infrastructure projects. So we've got the Levelling Up Fund, which is funding various projects around Lincolnshire. We've got the A46 dual link Newark, and we've got the Lincoln Eastern Bypass. Again, that will hopefully provide opportunities for construction companies in our area. It's interesting with the A46 and the Lincoln Eastern bypass that we're going to try and build that at the same time, which I think is a bit strange that there are only so many people and so many machines to do that work. So it'd be interesting to see what effect that has on the cost of those projects, and more importantly, the availability of people to do that work. Looking further afield, again, a publicly funded project, Sutton-on-Sea Cultural Hub, worth about £6 million. Lincoln Barbican Hotel in the centre of Lincoln, which is a joint project between the university and the co-op. Again, a large project. And what I am seeing a lot, and I'm sure you're seeing the same, is many conversions of commercial premises into residential and leisure. And I think as the high street changes, I'm sure that will be an ongoing feature. The latest one I saw was a bank on Mapley Top being converted into a bar downstairs and 3 apartments upstairs. And I'm sure we've all got examples of those types of projects. Unfortunately, it's not all good news. We've seen some recent failures, both nationally and locally. The common theme of these failures tend to be spiralling costs, the labour shortages, supply chain issues, and the wafer thin margins. When you look at some of these businesses, you get the feeling that these businesses have chased turnover and taken their eye off profit and got themselves into what should have been quite lucrative projects, which have been delayed for various reasons, which have then turned out not to be profitable, and quite simply the money's ran out. And again, if you look at these businesses, as I often do, you look at the balance sheet, the last published balance sheet, and you think that's a strong business. So from the outside, these businesses seem strong, but unfortunately, that didn't prove to be the case. And I think for all of us, we need to look at our own businesses and think, what would a failure mean to me, whether that be a customer or a supplier? What would a failure mean to me, and how can I protect myself against those risks? So thinking about your own business, as with any business, construction companies and those in the property arena are exactly the same. Plan, plan, and plan. Cash is still going to be king. It's always been, and it always will be. Profit and cash flows forecasts are vital, and these are forecasts which are kept up to date on a regular basis, whether that be weekly, monthly, annually, not just put into a drawer at the side of the desk. Borrowing is becoming more difficult. We know it's becoming more expensive, and we know that certain lenders are being more reluctant to lend to construction and property-based businesses. And we know within the industry that payment terms are becoming longer. So we all need to look at how that might affect our own business, both in terms of profit and in terms of cash flow, and make sure we remember that cash is always king. I won't deal much about taxation. Taxation is Matthew's things, but just to say, we're seeing an increase in corporation tax, we're seeing an increase in tax on dividends, and we're seeing a decrease in the additional rates of tax. Looking at it from a business side of things, what that's going to mean is that businesses are going to need to make more profit to be able to extract the same income for the owners, or alternatively to recycle that money back into projects for the growth of the business. So again, we know we all have to pay tax, but I do think the corporation tax rate of 25% will be a major disincentive to a lot of businesses, and I don't really understand the logic between going from 19% all the way to 25% in one fell swoop. So in summary, construction and your businesses continue to be vital to the success of the UK. We're still going to have challenges with inflation and cost of living, and that cost of living challenges may reduce demand. And like I say, we are going to have increased costs. They may stabilise, but they're certainly not going to reduce. So now I'd like to hand over to Matthew, who will take over and lead us through his thoughts on taxation and how it affects.
Thanks, Simon, and good morning to everyone. Hope everyone's well. As Simon said, my name is Matthew. I am one of the corporate tax directors here at Duncan & Topless, and I'm here to talk to you today about all the tax impacts that could affect your business in terms of property and construction, and what we can do to try and mitigate that as far as possible. So, what's on the agenda? I can get the agenda up. There we are. So you can't really talk about property and construction, or while I can't anyway, without talking about capital allowances. So that's going to be first to have a chat about. I'm going to talk to you about land remediation relief, which is known to us, but is a lesser claimed relief. So I'm going to talk to you about that so you can watch out for it. I'm going to talk to you about the individual versus the company buy or build to let differences. As Simon said, with the interest rates going up, this is going to be a key factor in terms of how you end up structuring your business going forwards. I'm going to give a refresher on stamp duty land tax and some of the changes that came in with effect from the 1st of April 23. I'm going to talk to you about structuring your business, especially with the interest rates going up, some of the economic impacts that Simon spoke about, and how we can think about protecting your business for the future. I'm going to touch on research and development, and I do mean I'm going to touch on it, and I'm going to tell you what it is, because we've seen quite a few spurious claims, shall we say, from boutique firms into this sector. So I'm just going to give people a bit of a reminder and a refresher on what that is. Then I'm going to go through some other taxation highlights, or maybe not highlights, depends on how you look at it. So let's start off with capital allowances. So qualifying expenditure, what is it? Well, most of us know if you went out and bought a digger, you're probably going to claim capital allowances on that, or a crane as well. There are some things in your property though that you can claim. So if you're buying a commercial property to rent out or to occupy for the purposes of your trade, or otherwise you're selling a commercial property, maybe these are some things that your customer can be wise to. So things like your electrics within the building, your data connections, things like carpet tiles, the carpeting itself, the air conditioning systems that you're putting in, all of your distribution boards and switchboards, as well as all your door handles and your door hinges. We'll claim all of those as well, and all of it qualifies for capital allowances. Don't forget that from the 1st of April 23, the government brought in full expensing. That is for new and unused plant and machinery only. Now that does include ex-demo plant and machinery. And there was a case quite a long time ago, I think it was back in like 1930 something or other, about an ex-demo car that most of us tend to hang our hats on when it comes to that sort of thing. So if you're buying some new and unused plant and machinery to include ex-demo, you can write 100% of that cost off against your taxable profits. So please do highlight when you're sending in your books, your records, etc. This is new and unused. It wasn't secondhand. We will ask the question in any event, but it's always best just to make sure we're making that claim. Solar panels. I've said this a couple of times during the budget speeches as well. A lot of people are coming to clients out externally and saying, claim full expensing, claim super deduction, claim X, Y, and Z on solar panels. Solar panels are a special rate pool item. They don't qualify for full expensing. They qualify for 50% write-off in year one. The other 50% may be covered by annual investment allowance. That's a separate relief from full expensing. So we could still completely claim at 100%, but if you've maxed out your annual investment allowance on other items of plant and machinery or special rate pool items, you might not be able to get 100% on your solar panels. So who can claim capital allowances? Well, those in business. It doesn't include items in stock in trade. So if you're a property developer and you're developing properties to sell, you can't claim the capital allowances on that development, but your end user may be able to. So it usually revolves around commercial property. So it includes renting commercial property to third parties, as I said, occupying it yourself. Furnished holiday lets are the only type of residential property that could claim capital allowances, but you can only claim them on your white goods and your furniture. You cannot claim the integral features. So that is your electrics, that is your air conditioning, if you did have air conditioning in your house, etc. So when can you claim it? Well, usually when the asset's brought into use. So you buy it, somebody ships it across, you take delivery, you then start using it. That's when you can usually claim your capital allowances. There is a second point, which is when the obligation to pay becomes unconditional. It's a little bit more complex, a little bit more technical, but ultimately one way or another will claim your capital allowances, but sometimes it might just be a case of timing. When it comes to assets under construction, however, there's some special rules. So when you're building a property, and if you're building a property to rent out, or if you're building a property to occupy, and it's a commercial property, you can claim as you go. But it's when certification takes place. So when somebody comes in and signs that off in terms of, yeah, I'm happy that stage 1 is complete, that's when we can start making that claim on a proportional basis of those assets that you've put into that building. Okay, usually stage 1, stage 2, you're talking about foundations, you're talking about structure, but stage 3, 4, etc., when you start your first fit out, that's when the claim starts to get, as we would call, a little bit exciting. I'm going to try and avoid using the word sexy, but some people do say it. So lots of different types of building have different expectations in terms of what those capital allowances look like. If you're building a luxury hotel, for example, up to 40% of that qualifying cost could be there. Modern offices, we see usually about 30% of the total build cost will qualify. Light industrial, possibly anything up to 10%. So just broad rules of thumb, and you'll hear me quote the broad rules of thumb, but you can't hold me to it until I actually do the work. A contract sum analysis is absolutely vital in order to be able to do this, otherwise it's just going to increase costs. So if you're a property developer, please do, I know you've got to in any event, but if one of your clients comes across and says, can I have a copy of the contract sum analysis, that's probably me in the background asking for it, so it'd be great if you could send it across because it's really going to help. So we're going to get into land remediation relief now. So it's actually been in since April 2009. It's aimed at companies that are engaging in cleaning up land from a contaminated state, and that's land that's been acquired from third parties in that state. Now, this is a motivator. So the government are trying to ensure that companies, so this applies to companies, not individuals or partnerships, are rewarded for acquiring that land in a contaminated state, which usually has a depressed value, and then spend money in order to change that into much better for the environment, much better for the people, etc., etc. So some examples of contamination, well, arsenic, radon, Japanese knotweed, those sorts of things. If you're removing those from your buildings, from your land, then you may qualify, the cost may qualify under this scheme. So you can claim 100% deduction on some qualifying costs. So assessing the land, removing or containing the contamination, any remedial works carried out in relation to that land as well. And then you can claim another 50% on top of that. So if you spend £100, the government's going to give you an extra £50 on top in terms of your corporation tax deductibility. Okay, and it doesn't matter whether or not these are capital costs. So they don't go through your profit and loss. They're rolled up into the cost of constructing that building. Or if they're actually profit and loss, we can make an election. We can claim 150% of those costs against your corporation tax profits. If you incur a loss as a result of remediating land, well, you can surrender that loss and you can get yourself a tax repayable credit from the government. I recall it's somewhere between 10 and 14.5%. I love the picture, by the way. If you're remediating your land with some of those tools, well done. I don't think I could even garden with some of those. As Simon mentioned, and Simon, I've stolen this slide from you, the Bank of England base rate's going up, and that's going to have an impact. That's going to have an impact against your profits. That's going to have an impact against nearly everything that you do. In particular, though, I'm going to focus on what that looks like in terms of the buy-to-let market. As many will know, because this has been coming in since April 2017, your interest relief for your individual buy-to-let landlords has changed. It's been restricted completely. So under the old system, you could just deduct the interest from your taxable profits, pay the tax accordingly, and anything else you retain. You don't get that anymore. The government aren't allowing you to deduct the interest as an individual. You get what's known as a tax reducer. So you take the whole interest, as you can see in that second column, whole interest out of your tax calculations. You then calculate your income tax accordingly on that profit, and then you get 20% relief on the interest that you would have already ordinarily incurred. Well, that's all well and good, but actually when you take into account that you are actually paying the interest in any event, what's happened is simply that your income tax has gone up. It's leaving you less in your pocket. What's worse is that as a result of this, it could continue to push you into a different tax bracket. As Simon highlighted in his last slide, especially with the rates of additional rates of tax dropping from £150,000 bracket to £125,000 bracket, you could end up finding that you're paying 45% tax on income that you actually haven't even had. It's just as a result of this interest changer. So a lot of people are now thinking, and have been thinking for a while, well, how do I get around this? Well, we could incorporate you. We could change you from an individual into a company. And as you saw on the last slide, that's going to mean that your interest is deductible accordingly in the normal way. But there are always taxes involved when you do a transaction. I hate to say it, it's why I've got a job, but ultimately you've got to think about it. And when it comes to an individual transacting in property that's investment, you've got capital gains tax to pay. You've got stamp duty, land tax to consider, and the company will be paying that as it buys your properties from you. That's all incorporation is. It's you're selling your properties to a company, and the consideration for that could be cash, it could be shares, it could be a mix of both. There are ways to get round of both of these taxes. So if you've got a sufficiently sized portfolio that you're carrying out what HMRC would deem a business, then you could incorporate with what's known as incorporation relief. That would potentially get rid of your capital gains tax in its entirety. So you would effectively gift your properties from yourself to your company in exchange for shares. Stamp duty land tax is a bit more difficult. Regardless of whether or not there's any actual money passing, there is what's known as a market value rule. So it's as if you've sold those properties to the company for full market value, even if you don't get any money from the company. The way to get around that potentially is through partnership structuring, but that's complex. I'm not going to go into it on this webinar because I could literally spend hours talking to you about it. But if you do think to yourself, well, yeah, my mortgage is coming up for renewal, I do want to stay in the buy-to-let sector, but the rates right now, they're looking at anywhere between 4 and 6% for buy-to-let properties. I'm still leveraged at 75% loan to value. I'm going to have a think about what I do in terms of my structuring. Come to us and we'll have a chat to you about it. Because there are always things to consider, both on the way in and on the way out. What do you do with that profit? Do you just use it to pay down your mortgage capital? Do you use it to build, to grow, continue to buy, or do you need that money to live on? If you need that money to live on, then sometimes we're just going to leave everything in your hands where it is. Okay. Stamp duty land tax, well, I've touched on it in terms of how to potentially get around it, but this is actually how much it costs. So if you've got a residential property, or rather you're buying a residential property, and it's your first residential property, then you will have first-time buyers relief. If you're replacing your main residence, then the rates are the ones on the left, so 0%, 5%, 10 and 12. If you're buying more buy-to-let property, and that's either as an individual, as a company, as a trust, then you'll be into the surcharge rates 3, 8, 13 and 15%. That's if you're using it as a buy-to-let. If you're buying a residential property in a company simply to live in it because all your money's in the company and it's cheaper than extracting it, well, you could be into a flat 15% rate of stamp duty land tax. That's where properties are valued over £500,000. The government brought this in a few years ago to combat all the foreign investment coming into the UK. There was a lot of money coming in from the likes of the Russian oligarchs, China, these very wealthy individuals overseas investing in UK property and simply to hold it. So the government tried to disincentivise that through the use of two taxes. One was stamp duty land tax at a flat rate of 15%, and the other was through the annual tax on envelope dwellings. That's an annual charge for holding that residential property in a company. There are reliefs against both. The stamp duty land tax is claimed when you claimed when you acquire that property. The annual tax on envelope dwellings relief is claimed annually by the 30th of April each year. If you don't claim that relief, you fall within that tax, and then therefore the surcharge must be paid, together with potentially any interest or penalties. You can claim the relief afterwards, but you're going to be subject to penalties as well. Best to get it done first time round. So if you're holding a property in your company that's worth £500,000 or more, then get in touch because you may need to make an ATED relief claim. So this is residential property stamp duty land tax. What about commercial? Well, commercial's a bit healthier. You've got 0% up to 150,000, 2% on the next 100,000, and then 5% thereafter. Commercial rates are usually what everybody tries to fall into when buying even residential property. And that's why we end up with what's known as mixed use property. So you've got your actual commercial property. So, for example, your light industrial unit. Then you've got a mixed use property. Well, that could be a shop with a flat above it. It could have forestry, which is maintained forestry on the land. It could be part of a working farm. That would be classed as commercial or mixed use. Or if you're transacting 6 or more residential properties in one go. If you do that, then you fall within these rates of stamp duty land tax rather than the residential rates of stamp duty land tax. It could provide hundreds of thousands of pounds worth of savings. So it's most definitely worth getting in touch if you're thinking about making such a transaction. Okay. I'm going to touch on structuring now. So as Simon said, as the economy starts to look a little bit different, you may want to think about structuring yourselves accordingly to protect your assets. If you've got a standalone trading company, so that's the one on the left hand side, you may have your property that you trade from or property that you rent. You may have your cash that's accumulated from years of profits. Everything's sat within a trading company, and that's easy. I get it. You've just got a single company. You may even have a single bank account to look at. All your money's there. All your property's sat within one company. Your accounts are easier to sign off. That's great. But that trading company is subject to commercial or financial risk associated with that trade. So what happens when something goes wrong? Well, the first thing happens is you call your insurance company and you say, do you cover me? And you hope that they cover you. But we all know what insurance companies are like. And I apologise if there are some people on the call that work for insurance companies. But the first thing is you can try and wriggle out of it. If you're not covered by insurance, your company has got to use all of its available assets to settle that liability. That could mean that all your cash is gone. It could mean that you have to sell your property. It could mean that the company goes under. That's the worst case scenario. But that's what we're here for. We're here to ask you about what that worst case scenario looks like and then try and help you navigate around that. And that's what the diagram on the right hand side of the screen looks like. That's how to navigate around these things. We put a holding company on top. This can be done in a tax-free manner, but it's subject to detailed tax analysis. And then what we do is we move those valuable assets from your trading company up to your holding company. We do that in a way that hopefully doesn't trigger any tax, and such that if in the future your trading company has that difficulty, it goes through that problem. I hate to be a bit callous, but the worst case scenario is you cut the trading company off at its legs and you can start again if you had to. All your property, all your cash is ring fenced. It's touch wood, hopefully safe in the holding company, and your trading company can go under and we can start again with the cash that you've generated from profits and all your hard work. If you haven't got, and I hate to say it's something as simple, I hate to say the word simple when it comes to tax because it's never simple, but if you haven't got something as simple as a holding company, trading company structure in place, and you've been going for quite a few years, and you've got that accumulated cash, get in touch with us because this is something that we'll be recommending you carry out. I'm now going to touch on research and development, and the picture in the background there is exactly what HMRC think research and development is. It's somebody in a lab looking through a microscope trying to figure out where the next big disease is going to come from. But that's not what R&D is in the general practice. So what is it? Well, you're seeking to achieve an advance in your knowledge or understanding in your overall field, not just in your business, but the process, the product or the service can still be in advance if it's been done by another company, but it's like a trade secret. So you don't know how they've done it. So you need to go away and figure out how they've done it so that you can then use it. To claim, you need to explain to HMRC that you've been trying to advance your knowledge and your understanding and you've achieved something new. So what's your innovation? And how did you overcome it? What was the uncertainty when you started out? HMRC are going to challenge you on this now. They've employed an extra 100 people into their R&D team, and despite the fact that we do reports for all of our clients, we're still seeing 1 or 2 inquiry letters come across the desk. HMRC are targeting the boutique firms that don't really care about you. They don't really care about R&D, and many of them don't even know what R&D is. I've been on the other side of an R&D claim for a construction firm where a boutique firm got in touch. They told that company, yeah, you've got a £500,000 claim here. And I looked at the claim and I thought, I genuinely don't understand what the new or innovative work that you're doing is here. I got on the other side of that boutique firm. It was a couple of lads. They were fresh out of university. They could crunch some numbers and put some percentages against it. They had no idea what R&D was. The claim completely fell away. And as you can imagine, the client wasn't too happy with that boutique firm. I'm not saying that all boutique firms are like that. There are a number that are very reputable. Just be careful if you're being approached by a third-party firm about R&D, especially if you've had the discussion with us first and with our specialist team. They've said, no, you're not doing it. The boutique firms, a lot of them are just coming across, putting your claim in, getting their 25% or whatever their percentages of the tax saving identified, then they're gone into the wind and you're left holding the baby. HMRC have said that they will be challenging more and more R&D claims that are in this industry, in the construction and property industry. And the reason why is HMRC don't know what the new or innovative thing that you're doing is. If you're putting up a steel girder in a slightly different way, then it's unlikely that you're doing R&D. If you're inventing something that's new in order to be able to construct this building, maybe there's an invention there, there's something new. But what you've got to challenge yourself is, did we know how to achieve that from the start? Did we get a third party to come in and they said, oh yeah, you need to do this, and then therefore that's done it? Or was it, we genuinely don't know how we're going to achieve this, so we need to go away and do a lot of trial and error and come back at it and then give it a go? The final part sounds like you might be doing R&D. The first two, definitely not. Okay, I'm not trying to be a downer. Everybody does R&D, and I love R&D claims coming across the desk. I'm just forewarning you that HMRC do see the construction and property industry as high risk for false R&D claims, and they're going to be challenging them more and more coming forwards. Okay. Borrowed Simon's slide again. Rates of corporation tax. So this is just our roundup. So Simon said they're increasing to 25%, but they're not easily increasing to 25%. As always, HMRC have got to make things as complex as possible. So what's happened is we've gone all the way back to probably about 2008, 2009, when we had associated companies, we had corporation tax marginal relief, and it made it all fun and games. Profits up to £50,000. Well, if you're only making £50,000 profit, you're a standalone company, you're going to be paying 19% corporation tax rate. If you're making profits between 50 and 250,000, you're then going to be into a marginal rate of corporation tax. So you're probably going to be paying about 26.5% on those profits between 50 and 250,000. If you're making profits over 250,000, as Simon said, you're going to be paying corporation tax at 25%. That's a flat rate. The limits are changed for short accounting periods and, more importantly, back to associated companies. We just had the nice, easy, related 51% companies for a number of years. HMRC have lulled us into a false sense of security, and they've pulled the rug from under our feet and taken us all the way back to where we started. So what is an associated company? Well, if one company is controlled by another, they're associated. They're actually into what we currently call the related 51% group companies. So that's an easy tick. If you've got two companies that are standalone, and many clients have actually expressed that they don't want to bring companies together because they don't want to fall within the now old related 51% group companies. If you've got lots of standalone companies and they're all controlled by you or you and your associates, and they all do kind of similar things, well, they're associated companies for the purposes of corporation tax, and so your limits are going to be changing. If each company's making £50,000 profit and you've got 5 companies, you're going to be paying a corporation tax rate of 25% going forwards. It's something to plan for, and it's something to watch for, because this is going to impact on your cash flow. And if you're not sure whether or not you're an associated company, but you've got 2 or 3, then get in touch, because we can let you know. We can carry out the analysis of the legislation. We can let you know whether or not you are an associated company, and then we can start helping you plan in terms of what that cash flow is going to look like. Okay. I didn't like the associated company rules when they were out, when they first came out. I definitely don't like them now, but nevertheless, this is where we're up to, and it is coming back in to tackle that mischief of everybody splitting their companies up into standalone companies to stay underneath the quarterly instalment payment regime, and everybody pays tax at 19%. Okay. That is the end of my slides. I'm back into how can Duncan & Topless help? Well, we're not just business services, we're not just tax, we are the Duncan & Topless Group. We encompass audit, corporate finance, if you've got issues with HR. We've got our own legal services team in-house. Our marketing team are doing incredible, and Will's actually on the call here and has put all of this together for us, so thank you very much, Will. But they can help your businesses grow, source new clients, source new markets themselves. If your bookkeeper's left, if you're struggling in terms of bringing in trade debtors, you don't have an internal finance team, well, that's where our outsourced finance team can help. Of course, we can always help with your payroll and VAT returns as well. That's it from me, Simon. I'm going to stop sharing and hand back to you. And thank you all very much for your attendance today.
Thank you very much, Matthew. That was great. It makes me feel very old when we look back to 2008 and think that was a long time ago. Yes, we just seem to go around in circles sometimes, don't we, unfortunately?
Absolutely.
We've got one question so far, which I don't know if you can see that, Matthew. I think it's squarely in your court regarding furnished holiday lets and capital allowance on heating systems.
So heating systems themselves, so if you've got electric heaters, etc., that all forms part and parcel of the normal goods. if you've got, if we're talking about radiators, and radiators would be fine. I'm talking about the pipes that run through the property themselves. That's classed as an integrated feature, and you can't actually claim on those. Whereas if a normal commercial property, you would be able to make that claim. I hope that helps.
Would that, so the boiler itself that's screwed to the wall, where does that sit?
Boiler repairs are absolutely fine. I think the boiler itself is something I'm going to have to look into, Simon, and take offline.
No
but
problem.
I can certainly follow up on that.
Yeah, I appreciate it. It's
quite a nuanced piece.
Write these rules to keep us on our toes. So, so yes, thank you for that, Matthew. I can't see any other questions coming through, so it just leaves me to thank Matthew for his contribution, and to thank everyone for attending. And as Matthew said, whether it be any question about tax, a question about property, or a question about any of the things that Matthew mentioned at the end there, then please reach out to either me or Matthew, or to your normal Duncan Toppers contact. We'll be delighted to have a chat with you. And I'd just like to thank you all for joining us, and I hope you have a good rest of the day. All the best.
Bye now.
Thank you.